Moving over to markets now, and you may have heard the news regarding hedge funds and a handful of stocks that caused some extra volatility on Wall Street. Well, I spoke with University of Illinois Ag Economist Scott Irwin this week. He says that instability didn't necessarily carry over to the ag markets, but he is tracking commodity prices, crop demand, and next week's WASDE report. We talked about all that, but he started by telling me what the big focus will be in the ag markets through February.
I think the big things that are going to be on the market's minds, one, the continuing assessment of what is the total size of Chinese demand for U.S. feed grains and oilseeds. This is the big question. I mean, we just saw those huge purchases of corn last week. I think that everyone in the marketplace is on high alert on that issue. And then I think you're beginning to see it, but attention is very quickly going to switch to acreage prospects for the U.S. this spring for corn and soybeans.
Yeah, let's talk about that. What have you been hearing in regards to acres?
Well, I've been fascinated by watching the market price movements for the new crop corn, soybeans versus the new crop corn. And the bottom line is the U.S. is going to be, it looks like, functionally out of soybeans by the end of the summer, next summer. And we have a large enough demand base built up that the market, I believe, has to incentivize an increase in soybean acreage of at least 6 or 7 million acres over last year. But the market then got hit with 172 bushel final yield from the USDA in the January final estimates. And so the corn rally took off and China's buying soybeans. And so you see strength in the corn market. And I think the market is really struggling with providing the proper incentives that I think are really needed to build stocks in the soybean market. I don't see any way how we don't need at least 91 or 92 million plus acres of soybeans planted in the US this spring. That's a big switch. In order to get that, you're going to have to provide some strong incentives relative to corn prices, but the strength in corn prices makes that all that much harder to achieve. So that's the way I look at it.
WASDE report coming out next week too. Any guesses as to what we could see?
Well, I think one of the big things that the market's going to be looking for again is the USDA going to raise their corn and soybean export estimates. They almost have to raise for sure the corn export number. I'm hearing a lot of chatter in the marketplace that they're going to raise it 300 million bushels. I actually think if that's the market's expectation, there's a good chance that there'll be some disappointment, because I think the USDA's position will be, yeah, China's buying a lot, driving the price up, but that means that we'll have some trade diversion and some of our other business will go someplace else. So that the net effect won't be a plus 300 million for the US. I would look probably for the USDA to maybe increase corn exports 150 to 200 million bushels. I could anything between 100 and 200 million up, I would find reasonable. And then another bump of 25 to 40 million at least on soybeans. So that's my expectation.
Scott, lots of great information from you today. Did you have any other marketing or risk management advice that you'd like to leave us with? Well,
I know it's been dry this winter in a lot of the Midwest. I want to emphasize, the analysis that I've done and seen of others is that, yeah, it might be dry next summer, but it might be really wet and a great summer too. And we need to, I think, just understand that the dry weather this winter doesn't tend on average to have much correlation with what it's going to be like next summer. And that's important from a risk management perspective. These are very high prices relative to what we were looking at just 6 months ago. So I think it's prudent to be doing some, probably more pre-harvest selling this year than a farmer would ordinarily do. I'm not advocating, super risky strategies like sell it all now because the price is high. No, but to me, as a minimum, if you're taking the federal revenue crop insurance, at least sell the part that you don't insure. Something simple like that. And even more than that, I think is probably prudent at depending on where you're at, what your opportunities are, but kind of roughly looking at $4 corn and $10.50 to $11 soybeans. Have any kind of reasonable growing season, that'll be profitable levels for the vast majority of producers. And so I think very hard about taking some of this risk off the table, because we're going to have huge acreage here in the US this spring. And if we get good weather next summer, we're going to have huge crops and prices will go down very rapidly.